Hello, Anthony here from Bulk Mortgages. In this video, we're going to be going through the mortgage myths and misconceptions that people have when getting their first property. A lot of people get advice or hear things from their friend Dave down the pub, or their auntie or uncle bought a property 30 years ago, and because the mortgage market is so dynamic, things change very frequently. Today in this video, we'll be going through the main mortgage myths that we hear and explain it in a bit more detail as to how they are incorrect. If you're in your arranged overdraft, it is still possible for yourself to get a mortgage. However, lenders will use this as an outgoing when they're calculating their affordability. The lender's main priority is that you're not financially overstretched. So as long as being in your arranged overdraft does not overstretch your finances, you can still get a mortgage. If you're actively using your bank's overdraft or paying one off, any repayments that you're making towards this overdraft will be calculated in the lender's affordability assessments. Contrary to popular belief, you can still get a mortgage if you've got bad credit. Not all bad credit carries the same weight when the lenders are assessing your affordability. For example, bad credit that was 6 years ago will not be looked at as in the same light as bad credit that was calculated a year ago. The further away the bad credit incident, the higher chance you've got of being accepted for the mortgage. Some lenders, if the bad credit was a long time ago, some lenders and high street lenders will take a bit more of an open-minded approach, and they can still potentially lend to you as long as you've got the right deposit to put down alongside that. If your bad credit was a bit more recent and you can't get agreed with a high street lender, there are still lenders that specialise in people that have got impaired credit. A word of warning, however, because there is higher risk lending to yourself because of the credit issues, the interest rates tend to be slightly higher than the same rates that you would get with the high street banks and building societies. If you're moving home and you are in a fixed rate mortgage, there is an option for you to port your mortgage over, which is in theory, you're just picking your mortgage up that you've currently got, taking it to the new home, and then borrowing any additional amount you need to on top of it. In order for this to be accepted, the lender would still need to carry out a valuation on your new home, and the top-up mortgage would need to be with the same lender. The benefits of porting your mortgage over is fixed rate mortgages tend to come with early repayment charges. You porting your mortgage over means you're not breaking your current fixed rate term, and in theory, you can transfer that over and borrow the additional amount without incurring any extra early repayment costs. Lenders will still assess your affordability when you're porting your mortgage over. So if you're borrowing an extra £50,000 and your current mortgage is £250,000, the lenders would calculate your affordability to see if you can borrow that full £300,000. Subject to that affordability being there should be no reason why they can't move your mortgage over to the new home as long as they're happy with the property you're buying. Keep in mind, when you're porting your mortgage over, the top up that you'll be getting to buy the new property is not going to be at the same interest rate that your current mortgage is. When it's time to remortgage and your existing fixed rate deal has expired, staying with the same lender might seem like it's the easiest thing to do. However, just because one lender was offering you the cheapest deal when you got the mortgage out, doesn't necessarily mean they can offer you the better deal now. Just because your existing lender was offering you the better deal when you first took the mortgage out, it doesn't necessarily mean they're going to be offering the same one now. For the half an hour to an hour conversation with a mortgage advisor, they'll be able to scour the entire market and see if anybody's offering you a better deal than what your current lender is. Consider looking into your mortgage options 3 to 6 months prior to your current mortgage expiring. That gives you plenty of time to scour the market, speak to advisors, and get the new mortgage set up prior to your product going on the standard variable rate.